Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have Peter Davies of Jigsaw Trading, better known on the forum as Dionysus Toast. At least that's how I pronounce it. And he's going to be doing part 3 of a multi-part webinar series on order flow trading. If you missed the previous 2 parts, you can find them on BMT, the webinar section. The bullet points for today's webinar include setting expectations, performance tracking, order flow as a method versus order flow as an additional element, order flow expectations in crowded and uncrowded areas, iceberg orders, manipulation, stop runs, and avoiding negative impact as you introduce order flow into your trading. The webinar is being recorded like always, and I'll post the recording on BMT sometime tomorrow. If you are watching the recording at a later date on YouTube and you like it, please do us a favor and give us a thumbs up. It does help us out. Peter has asked that you hold the questions until the end of the presentation, at which point we'll open it up and take Q&A. All right, guys, so thanks, Pete. Thanks for coming on here at midnight your time to get this done. I'm going to turn control over to you right now, and we'll get started.
Made it here today. As Mike said, today we're going to talk about how to introduce order flow to your trading. And that means you personally, because we're all in a different situation, we're all at a different stage with our trading, and we have to kind of figure out how we're going to do it first. Now, of course, there's not just one way to do this. But there are common pitfalls you can avoid, as well as things that help with the learning process. Now, because of what I do at Jigsaw, I am fortunate to be in a position where I talk to lots of traders. Now, the majority of the people I talk to are people struggling with their trading and looking for help. But I do get the opportunity to speak to brokers, educators, authors, full-time retail traders, and professional traders of different kinds as well. Now, contrary to popular belief, I have found that the successful traders I've been in contact with are very generous with both their time and their information. So what we discussed today should really be credited to those people, and they know who they are, and not really just to me specifically. Now, for those less successful people I talk to, they have lessons to teach too. And I'm going to discuss a few cases today. And if anyone here recognizes their own story, I do apologize, but this is sort of for the greater good. Okay, I presume you can all see my screen. It says you can anyway. Now, I'll let you read this on your own. And what this represents as you go down and read this slide is the worst case scenario. So this is an example from Jigsaw. I'm pretty sure it's no means exclusive to Jigsaw. So when I got the email about this guy asking for a refund, I was quite conflicted about what to do. So part of me thought, just give him the money, don't get involved, just stay away. But the trouble is, I'm not very good at not getting involved. So what I did, I processed the guy's refund, and I reached out to him by email saying, look, I think the approach that you're taking there was a bit rushed. And that anything you try in trading, you really should consider the merits of taking baby steps, to not just jump in. And we had a pretty friendly discussion about it. We both agreed he'd been very, very hasty. But we also agreed that Jigsaw probably wasn't for him, and mostly because of the negative experience he had and how that could weigh on his mind in the future. And that's going to be a big part of what we talk about today. I know FT71 talks about negative emotional capital. Well, this guy built a ton of negative emotional capital in 3 hours, and I don't know if you could ever have gotten over that. So being keen is fantastic. Having an enthusiasm and energy is great, but we have to channel that energy. Order flow in itself can be very obvious sometimes, but a lot of the times the signals you get are quite subtle. And they also need to be taken in context, not isolation. And many people, in that excitement of the moment, they lose sight of context, and they just jump on the signals despite the fact the context isn't there. So with that initial enthusiasm you have, it's best to focus that enthusiasm on developing your skills, not just jumping in with both feet. So it's better to learn to utilize order flow without going through lots of unnecessary negative experiences in the process or building that negative emotional capital. And that's basically what we're going to look at today. So we're going to look how to introduce order flow to your trading without taking on unnecessary risk and without negatively impacting your trading. Now, any change to your trading approach carries risk, and order flow is no different. So before you start to make changes, it makes sense to manage and mitigate those risks. Now, just throwing in order flow isn't going to work, but the reality is that this is exactly what most traders do. Now, we're going to look at the risks themselves and how you can implement order flow based on where you are with your trading right now, so you can make your own personal plan for moving forwards. We're also going to look at the idea of having short-term and longer-term trading goals as an alternative to have just profitable as being the single destination you have in mind for order flow, or indeed your entire trading career. And finally, we're also going to discuss gameplay as we go along and the consideration of trading in crowded and uncrowded areas when you're using order flow. Now, throughout our webinars, the first two webinars, we've used the analogy of icing on the cake. So for many, the cake is the ability to define a location to enter a trade through some means other than order flow. The icing would be using order flow to confirm or refine or help manage that trade. Now, order flow in itself can be both the icing and the cake. It can give you a trade location and it can give you entry confirmation. And that's really what scalping is all about. Now, before you go adding order flow to existing trading methods, you have to be very honest with yourself about how well your current methods are working. Okay? Because most people aren't looking at order flow because everything's going really well. Now, if your current methods are not working for you at all, then order flow is unlikely to fix them. So if you're trading off moon phases and horoscopes and that's not working, then using DOM and time and sales is unlikely to remedy that. Now, don't take that the wrong way. So I'm not singling any method out, and that's why I said moon phases and horoscopes. I presume we don't have many of those guys in here. I'm not calling anyone a dummy, but it is a reality of this industry. There are lots of bogus methods for sale out there. So with this being the first day of the rest of your trading career, and a time when you may be considering looking at order flow, it's also a good time to have an honest review about the methods you currently use. In short, do you actually have the cake right now? Now, many of the retail traders I talk to have no idea whether they have the cake or not. It's only the minority that have a decent historical trade history to look back on and analyze and understand what's working for them and what isn't. And then, of course, there's the traders that are switching methods every few weeks because nothing works. And the funny thing is, it's likely that those traders have stumbled across a number of things that might have worked if they treated trading as a skill to be developed rather than a problem with a fixed solution. And this isn't just retail traders. So I know a trader, in fact there's probably people in this room that know this guy as well, because there were a lot of us chatting on Skype at this point. We had a big Skype group going. But I know a trader that gave up his day job in banking. He got a position in a prop shop and spent 12 months earning just $800 a month. It was basically a stipend payment the prop shop paid him, and he was working in central London, right? $800 a month. He was sitting in that prop shop and he spent 12 months adding one ingredient after another, constantly changing his technique for a full year until finally going back to a paid job. And this is with constant contact with a group of people on Skype, all telling him to stop changing what he's doing, to just stick with it. Now, he watched other people come into that prop shop after him and go live while he was still on this perpetual quest. And he was a very, very smart guy. This guy was no dummy. He left a job in banking, okay, to go into the prop shop. But maybe that intelligence was to his disadvantage. Maybe those less inquisitive interns that just did what they were told were the ones to make it. Now, I don't know for sure. Obviously, there's no way I can actually prove that theory. I just kind of suspect that to be the case. So for those of you in this perpetual seeking cycle, order flow also will not be the quick fix you're looking for. Okay? So if you're considering a change to your trading, and this is something you're doing every few weeks or months, I want you to consider, listen to the following and just have a think about what it means. Okay? So consider this possibility, that there are people out there right now that know much less than you about trading, and they're making money day trading on most days. They don't know any secrets. There really are no secrets. It's the fact that some retail traders think professionals know secrets and they keep looking for them is one of the things holding them back. The point is, you're rarely going to know with 100% certainty that any individual trade is going to work. Order flow is also not going to give you 100% certainty. Okay? It is going to help tip the odds in your favor. It is going to give you an earlier heads up whether a trade is working out or not. But order flow can't fix something that simply doesn't work. Okay? Order flow is also not really a quick fix. It is a skill that you develop and improve over time. And we're going to give you some time scales a little bit later on. Okay? So you'll want to know how long before I can benefit from order flow. Okay? Now with the right approach, some level of understanding this is, will come to you within hours. And I'm talking 4, 5, 6 hours. And with the right approach, you should be able to introduce changes to your trading within weeks, and you absolutely should be seeing measurable progress as each subsequent week goes by. So you have to set your expectations accordingly. Now if that's not acceptable to you, if you need results on day one, then it is absolutely possible that order flow isn't for you either. Now order flow isn't a technique. It's a set of information, just like a price chart. And that information can be used in many different ways. Not all of them obvious. I mean, I've been looking at this for a long time, and I recently had a bank trader come to me, and he showed me a method for trading crude oil, scalping one tick out of crude oil, and it was just using stuff that I'm just, wow, I didn't, that wasn't obvious to me. But even when you've got experience, many years experience of this, there's always going to be things that other people do with it that you kind of like, oh yeah, that makes sense, but you probably wouldn't have thought of it yourself. Now the list on the screen right now represents the path I think somebody new to order flow should take to get the most in the shortest amount of time, and in terms of building upon the skills you learn as you go. Now I did not go learn these things in this sequence. This is me looking in hindsight and thinking, well, if I knew then what I knew now, this is what I'd do. So the first stage in the learning process is being able to actually read the order flow or absorb the order flow. This is a stage where the progress comes in hours, and when people usually have that aha moment. Okay? This is simply nothing more than the ability to read the flow of orders as the information comes in. This is not attempting to interpret the information in any way. Of course, this is the part that most people skip because they just want to get in and start trading off the information. Now if you can read the order flow, then within weeks you should be able to use order flow to help you manage your trades. So the trade management, deciding whether to stay in a trade or not, involves the simplest order flow reading skill, and that is reading momentum. Trade entry refinement, deciding whether to enter or finessing a better entry price, requires a bit more skill, because for most trading styles that involves identifying a turn in the market as opposed to just seeing if there's momentum there. Reading the market state, whether a market is trending or consolidating, whether a market is liquid or illiquid, anticipating changes in volatility, that takes time to learn. But not so much because it's difficult, but because you have to watch a lot of days to get a feel for what level of participation leads to what level of volatility. You need to watch, for instance, lots of ranges form to get a feel for how ranges form. Now using order flow to define a trade location requires you to understand conceptually where groups of traders are positioned and areas where traders may defend a position, and where one side might be shy of trading into a level because they just lost money there. Now, this is definitely a skill, but what you're also doing is building confidence in the way things play out. And that's seeing something occur time and time again so that you have the confidence to trade off it. So it's partly a skill, partly just building that confidence. Now, stop runs, I remember the first time I ever heard a trader say, that looked like a stop run. And when I heard that, I'm like, wow, that's kind of, that's awesome that somebody could actually tell that was a stop run. But if you know where people are likely to be positioned, then you also know where they're likely to be stopped out. Sometimes you get to a level where you expect stops to be hit and there's no reaction. It doesn't happen. Nobody cares. They don't stop out. They just stay in. And sometimes there's a flood of trades. But you can certainly see when the stops get hit. And it follows that when a large number of traders lose money at a level because they've been stopped out, subsequent action, when you come back to that level, tends to play out in a certain way. Hence the importance of knowing whether stops were triggered when we left. Now, as you move on, anticipating breakdowns and breakouts is an interesting proposition because now you're anticipating a stop run in the moment before it occurs. That's very interesting, particularly if it's your stop that's about to be run, because you can get out before everyone else does. You can also use it to trade into stops and benefit from them. It's not something I personally do. I know people that do it who will actually buy the top of a trading range because they think now it's going to break, okay? And it is quite a tricky thing to do, so it's not something you want to try on day one. For me, I like to be able to anticipate a stop run just because I don't want to be on the wrong side of it. Now, there is supposed to be a reduction in the amount of manipulation with the new CME rules that went into effect, or rather a reduction in the amount of spoofing. And it hasn't really, there hasn't really been a reduction in spoofing, and kind of, we can maybe talk of this in the Q&A. It really hasn't stopped the spoofing, and it's kind of difficult to see if it's really stopped, certainly on the treasuries. But we've got to see how that's going to play out long term. Certainly, the guys that have been caught and reported about have been trading very small amount of contracts, which always makes me a bit suspicious. But anyway, it doesn't matter what they do, there's always going to be people nudging the market around. And there are certain plays that are made and that you'll recognize over time. And like the breakdowns, anticipating those, you don't necessarily have to trade with manipulation. But what you do need to do is you need to see when it's going on, because if you see signs a large player is trying to push you and others out of position, you might want to consider getting out of that trade before the bad thing happens. So it's possible to benefit from using order flow fairly quickly with the right approach if you have the attitude that you can take the gains one step at a time. Okay, now this is something nobody wants to talk about. I had a chat a while ago with a trader who was generally doing really well. He had just some fantastic days, and then other days he'd be all doom and gloom. And he Skyped me and saying, look, Pete, I'm having a bad day, a really bad day. So I said to him, okay, how do you know it's a bad day exactly? Which probably sounds like a bit of a dumb question, because his answer was, well, I lost money. So I asked how much of a loss would be a normal losing day for you, and how much of a loss makes it a really bad losing day. I asked which methods he was applying today and what his expectations were in terms of win rate. I asked if the sort of action we were having today was one where his methods tended to do well. I asked if his trade frequency was particularly high or low today. Now, this sounds like me being a smart ass, but I was seriously just trying to quantify by what measure it was a bad day, and then figure out what on earth I'm supposed to say to him. Because it's only a bad day if you go outside of what you could normally expect to lose, considering the trading conditions for that day. Now, of course, you probably guessed he couldn't answer a single one of these questions, and we all know why. Because journaling your trades is something that trading educators tell you to do and that nobody actually does. Okay? And one of the problems with journaling your trades, the big problem I think with journaling your trades, is that you'll start doing it when you're losing money. Okay, so your journal isn't going to be pretty. I mean, who wants to be reminded that they are losing money every day by writing it down? It's pretty depressing. After a bad day, you might just want to switch off the lights, reset the sim account, and tell yourself, I'm not going to make those mistakes tomorrow. But you're throwing the baby out with the bathwater. If you do that, you're going to omit the good stuff from the journal as well as the ugly stuff. Now, if you want to introduce order flow to your trading, making a fundamental change to the way you make decisions, how can you go about that without having a way to review the impact of the results, to know how well it's actually working out for you? Can you just go by profit and loss? I mean, what if one aspect of order flow is working really well for you and one not so well? Is your P&L going to show that? Well, probably not. And what if you're fading all the icebergs, but that's only working when it agrees with the overall trend for the day? In the heat of the moment as you're trading, are you going to be able to mentally track your performance to figure out what works well for you and what doesn't? I know I certainly couldn't do that. Maybe some people could. So as a minimum, I would suggest you segment your trades into trade types or setups and give each one a name, like a range scalp, a pre-breakout, a measured pullback. And also make sure you record what the market conditions were at the time. So is it trending, consolidating after a move, is it moving on news, that kind of thing. Now each of those named setups should have some guidelines on how to execute and in which conditions they should apply. And that's your trading plan, basically. Now your plan shouldn't be too complex. It should be something you can keep in mind in the heat of the moment. So if your trading plan has 5,000 rules or guidelines, it's going to be almost impossible to follow that in the heat of the moment. Now you should separate out the trade location portion, like for example double top, from the order flow portion, for example absorption with large bias traps. So you have details for both the icing and the cake. Now when you trade, you should write down the trade type, the order flow signal, the market conditions, how far it moved your way, how far it moved against you, and how well you followed your plan. Now this is tricky. I find this personally tricky because the best notes about the entry conditions are made right when you place the trade, when it's freshest in your mind, but that's also the time when you need to be monitoring the trade closely. Now if you leave it till after the trade is closed or longer, you may lose some of the detail. And you might also find yourself inclined not to write down the details of the losers at all. Now, of course, you can log information about other things you watch, a nice tick, correlated instruments, liquidity, volume, but it can be cumbersome. And the more you log at the time, the longer you have your eyes off the market. So I'd also record how well you follow your own rules. So give yourself a 0 to 5 rating on that, because you might find that you'd be profitable if you stop taking those off-plan trades. Now once you start logging, again this is pretty common advice, give it 20 trading sessions before you review the results. You shouldn't make any changes to how you trade until you've done those 20 trading sessions. Because if you change anything in your method during those 20 trading sessions, you're basically going to invalidate the results. Now of course if something is turning out to be a complete disaster, then you've got to drop it obviously, but within reason you should not be tweaking anything. Now, of course, if you're scalping for ticks and placing 200 trades a day, you probably don't need 220 sessions to see how well it's working from your log. Now, the trader I mentioned at the start of this slide that was having a bad day contacted me 2 days after we'd agreed he'd log his results and not change anything. And this conversation we had 2 days later was, I'm going to add in footprint charts. I'm like, okay. I thought you were going to stop changing the way you trade. And he says, yeah, but I'm not changing the way I trade. I'm just adding in footprint charts for more information. And I replied to that, that's pretty much a perfect description of changing the way you trade. And this is just like, it's some sort of addiction for some people. And if this is you, you have to stop keeping making these changes or you will absolutely never succeed. Anyway, after your 20 sessions, you can take a look at the results. You might find that some setups are totally useless. And you might find some setups are good when you follow the rules, but lousy when you deviate. And you might find that, for instance, absorption works with one setup like a pullback, but not another setup like a double top. And that actually is quite a hint, so keep that in mind. Now, once you've done this, you're in a position to make an educated choice about any changes. Drop a setup, follow your rules more closely, only take certain trades on certain matching order flow confirmation. You can make educated decisions. And the end goal is for you to find out what works for you. And that knowledge brings confidence. The confidence stops you doing dumb things like moving your stops out of the way just in case it comes back. And this level of confidence is effectively the secret to trading that lots and lots of people are looking for. Okay, so that kind of ends my rant on logging, but basically it's pointless implementing changes to your trading, like major changes like implementing order flow, without having to wait to know if that change is working for you. And I agree, logging isn't fun, because you're going to do it when you're losing money, or that's when you're going to start, but it is really effective. Now, let's say you took a hard and long look at your trading, and you came to the conclusion that trading off Rick Santelli's tie color is not really working for you, and the order flow is unlikely to fix it. Now, I'd say the benchmark here is breaking even. If you're breaking even and covering costs right now, then what you have is probably fairly close to working. Anything less than that, and you really do have to consider just dumping it. I mean, you've got to be fairly brutal with this, right? There's no point kidding yourself. There's no benefit in saying to yourself, well, yeah, I'm losing 90% of my trades and my losers are bigger than my winners, but I think I can turn it around, because you won't. Now, my advice, if you have no cake, is to do what the prop shops encourage their interns to do and trade much shorter term with smaller targets. Now, I know lots of people won't agree with this. Now, I'm a slightly longer term day trader, and probably lots of you know that I post my pre-market prep on BMT each day, and that's basically looking at a bigger picture and considering where other traders might get all excited and sustain a move, or where traders might get, you know, stopped out, and also areas where we might just kind of lose interest. Now, I've been watching the ES for many years, and so I have a feel for how days can get played. So I go into a day with scenarios I think will play out, and sometimes they do, and sometimes they don't. And when they do, I can kind of recognize that they're playing out, and then I have an idea where the market might be taken. Now, that bigger picture feel takes a while to develop. There's no reason you can't be developing those skills right now, right from Monday, start developing those skills. But realistically, it's not going to have a major impact, positive impact on your trading in the next few weeks. Because the fact is, there is only one day per day, and you need to watch a lot of days play out to build that kind of experience and expectation. So it's not that hard to do this, it's just that it occurs over a really long period. So to get more experience in a shorter time period, my suggestion is that your short-term plan should be short-term trading. So start banking some profits, even if it's a tick at a time or 3 or 4 ticks at a time. You can still look at the longer-term view every day as you develop as a trader, but you're just not trading off it yet. Okay? Because making profit isn't necessarily the destination with trading, it's just one step in the journey. And you don't stop learning stuff just because you start to pull a little money out of your markets. Now, for smaller targets, I'm talking about the typical pop you would get off an order flow setup. So, for instance, that might be 4 ticks on the ES, and it could be 10 ticks on crude. Now, obviously, changes in liquidity are going to impact those numbers on a day-to-day basis, but basically, you get the idea. Sometimes it's going to slow down, it'll be 2 or 3 ticks on the ES, and sometimes it'll speed up, and it'll be 8 or 9 ticks on the ES. Now, retail traders tend to dislike small targets. Many retail traders start out with a dream of turning 5,000 into $1 million, or even trading off for a living off a $5,000 account. This means they try and hit home runs every trade because they need big wins to make enough money to live off their 1 or 2 lot positions. And it's not unusual for a retail trader to work backwards from their need to earn $500 a day to figuring that means they need 10 points per day from trading 1 lot on the ES, which is effectively 10% a day on that $5,000 account. And that is the ruin of many traders. Now, if someone said to you, just trade well, don't worry about the returns, build up a good track record in the next 12 months, and if you succeed, I'll give you $1 million to trade, okay? Then you'd be able to take a much lower risk approach. In fact, you'd find yourself not wanting to go for the hero trade because you'd put your track record and that $1 million at risk. You'd be able to focus on just taking a few good trades a day. You'd be selective, and you wouldn't be under any pressure to try and pick the top and the bottom of the market all the time. In short, you would actually be more likely to succeed. And the fact is, the money is out there. You take your 12-month record to a few prop shops, and it shouldn't be that hard to get a position somewhere. Now, as a short-term trader, you aren't trying to assess where the overall market is headed at a macro level, but you do need to be aware of major highs and lows, key levels, as there will be activity changes at those levels, and you might want to actually avoid trading into them. So you're looking as a short-term trader for levels to lean on, where you think there's going to be an imbalance. You're looking for trap traders, and you're looking for signs of manipulation. As a shorter-term trader, you do need a higher level of order flow reading skill, but you'll be getting more setups per day, and you'll be getting a lot more trading experience over a shorter period of time. Now, what you aren't doing as a short-term trader is just switching on the PC and taking trades every couple of minutes. Well, not in my experience anyway. You're still going to need to do some level of preparation every morning, and there will still be periods where there's just no trades available. Okay? And the guy I know that taught me this method on crude, to take one tick trades on a really mental market like crude, a really volatile market like crude. I understand it. I've seen what it does. I've even done it myself. There's times when there's just nothing on the table. There's times when you just have to wait for the opportunity. Okay? So you're going to need contextual awareness, but it's more like at a micro level than not a macro level. Now, if you do have something that's working reasonably well, then order flow becomes the icing on your trading cake. Most people look at order flow as something that primarily concerns entering to a trade, to refine a trade or to reject one. Now, I would agree with this, but I'd also say there's a very good argument for starting out by using order flow to manage your trades. So use order flow in the first few minutes of the trade until you have some breathing room in the trade. And this is because it is easier to read momentum than it is to read turns. So we can all see price if price is moving with us or against us. But you bring in the additional dimension of whether the order flow is backing up that move or not, it's really becomes something very powerful. So for instance, if you go long and you see 2,000 sell market orders and 600 buy market orders and price moving down just after your entry, chances are, especially if you've got a tight stop, you're probably going to be stopped out. You're probably wrong in this trade. Okay? Price is moving against you, order flow is moving against you. It's basically confirming the market's against you. Now, if you go long and you see 2,000 sell market orders and 600 buy market orders, but price doesn't tick down, okay, order flow is against you, but the sellers are getting trapped. You exercise caution, but you don't get out. So you're okay for now, unless the sellers manage to win out and actually push through that price that is being held. In that case, price is likely to accelerate to the downside, and if sellers give up, you should actually get a pop to the upside. Okay? So what you're doing in this situation is you're keeping an eye on the bidders, because if they start to pull out of the way, it means they're giving up and the sellers are going to push it down. Now, if you go long and you see 2,000 buy market orders and 600 sell market orders and price is moving up, you're basically peachy. You're in a good position. That's exactly what you want to see. Order flow and price on your side, fairly simple to read. So price can move against you without supporting order flow. Okay? You might enter long and price moves against you weakly. Price moves down, but there's no momentum behind it, no real volume of orders against you. In that case, there's really no need to exit the trade. Okay? Price is moving against you, but there's no order flow behind it. Okay? And all order flows are going to show you this to some extent. So your stop loss no longer becomes the place you exit the trade because price reaches it. Okay? You might work an exit before you get to your stop loss because of the order flow. Now, in some cases, you may widen your stop loss because the move against you is actually very, very weak. And obviously, you've got to use caution with that because you don't want to turn a day trade into a long-term investment. Now, order flow is going to reduce the size of your losses, but you have to be realistic about it. You're still going to need wiggle room in your trades. I had a guy that told me, he said, Pete, I love your tools. I just want to run my plan by you. He said, I'm going to fade prior highs on the ES with confirmation on the order flow using a 3-tick stop and a 10-point target. And his expectancy was that he'd be able to get a 50% win rate trading like that. Now, whilst nothing is impossible, that is certainly improbable. For sure, sometimes you're going to catch to the tick entries at times, and you will see the market make a good run afterwards. But to expect to hit trades like that every day and get a 10-point run, it's just something I've not witnessed anybody achieve. Okay. And if you enter a market order, so let's say you enter a market order on the E-mini S&P 500, and you buy the inside offer at 21.50. At that time, the inside bid is going to be 21.49.75, and your 3-tick stop is going to be 49.25. So that really, you really only need the bid to tick down 2 prices and for a single contract to trade there to get stopped out. So if you enter on a market order, a 3-tick stop really is just a 2-tick stop. Okay, so this idea of having really, really, really ultra tight stops, it doesn't work. You still need a bit of wiggle room. Now, unlike scalping, stopping out aggressively when taking longer term day trades, basically it's going to see you close a lot of good day trades early. Okay? So the big change, if you're using order flow as icing on your cake, for entry, okay, is that you have to shift from trading specific prices to areas, because it's as much about refinement as it is about confirmation. So let's say, in this case, your analysis showed you that I think this is a trading range, volume's low, it's moving slowly, there's not a lot of interest, so I'm going to fade the range. So from a pure chart perspective, you'd possibly be looking at a short 84.25 and a long 79.50. Now when you introduce order flow, you change that level to a zone. You expect the market to turn somewhere in that zone, and you don't enter until you see the absorption, you see buyers or sellers fading away, you see the opposite side jumping in force, you see large traders trapped, you see the gameplay, the manipulation, you see the bids or the offers pulling out of the way. If you don't see some of this, you know, not just one, maybe a combination of them, you don't see this, or you see it but you remain unconvinced, you don't take the trade. Okay? If you see aggressive trading into the level with price progression through it, you don't take the trade. Now, of course, you could just take the trade anyway and see if order flow comes in on your side after you've entered. Because remember, order flow is just a set of information. It isn't a trading method. Okay? It can be applied in many, many different ways. Now, as we discussed before, major reversals are the areas that lots and lots of traders like to trade. Everybody likes the double top. We're talking about major prior swing highs and lows, high of the previous day, low of the previous day, overnight high and lows. Minor reversals are those second entry pullbacks or small developing ranges. They tend to be created intraday on the fly. Now, if your method of analysis is identifying major reversals correctly, then generally you should see a reaction at that level most of the time. And you should also see changes in market depth going into that level. So at resistance, you will see large offers above you. Okay? So large offers are going to be above you. As you move up to your resistance level, you're going to see the offers are stacked. And this is one of the reasons that it's hard to see why the CME regulations are working, because this hasn't changed. It's just a phenomenon of the market that large offers are stacked at the highs or at resistance levels. Now, those large offers are going to be stacked, and you'll probably get some kind of reaction. But large offers and a reaction at the level does absolutely not guarantee it's going to stop and turn around. It just means it's a level that lots of people are looking at. Now, conversely, if you think this is a major resistance levels and the offers are not high above it, the chances are it's just you that thinks it's significant. So if you're playing a major reversal, you actually need other traders to be looking at that level. And that's one of the reasons this concept of secret price levels is kind of a weird one, because you don't want the price level to be secret. You actually want people to go and actually trade there because you want that reaction. Okay? You don't want to be the only one trading it. Now, on occasion, you'll see price go straight through a major level without stopping, but that's not the norm. The normal is for there to be some sort of reaction. And it's not necessarily a to-the-tick reversal, and not necessarily the full reversal you're expecting, but just some sort of reaction. And at these major levels, there's a lot more people jostling for position, and there's a lot more manipulation, because large traders will nudge the market around, pushing people out of position. And these are the areas, and this is why I call them crowded areas to trade. Okay? Especially if you think of a major level, a double top, you've got breakout traders that will trade if it breaks through, and you've got reversal trades if it reverses. So if the market looks like it's reversing a little bit, the reversal trades will get in. Now if someone nudges the market up, the reversal trades will get stopped out, the breakout traders will get in, and then they can push it down again and stop the breakout traders. That's basically the game that's going on. And they do that because it's crowded. Now I consider a pullback entry a retrace to a step in the intraday volume profile or a minor reversal as an uncrowded area. There's just not so many people jostling for position there. So as such, you have to consider looking for a lot more confirmation of the order flow from a major reversal than a minor one. Okay? You should also pay closer attention to managing a trade off a major level because of the tendency for the market to initially go your way and then get nudged around hunting for stops. Okay? So for example, in an intraday uptrend, we might see price moving up and it pulls back 8 ticks on the ES and suddenly nobody's there, no sellers are there anymore. We come down 8 ticks, we've got no sellers, we go down to the price, a few contracts trade there, then we tick up a little bit, we then come back down to the price and once again nobody wants to trade there. And that seller fade, that seller's disappearing, is a fairly weak confirmation on its own. But in a pullback to a step in the profile or maybe a measured move where the last 3 pullbacks were 8 ticks and we're already 8 ticks back, where the risk is well defined, that's more than enough for me to enter a trade. But on the other hand, if the market was in a downtrend and you were trying to catch the end of the downtrend, and seeing that seller fade in isolation is not something I would trade off, because the markets are going to wiggle around anyway. And part of that wiggling around process is occasional pauses. So differentiating between just a regular pause in the action and sellers laying off for good for a full intraday reversal, it's pretty tough, okay? It's more difficult in a major reversal than just fading away on a pullback in a trending market. So when overall momentum is to the downside, and we're in an intraday downward trend, you need more confirmation to take a shot along. Now personally, I prefer to see some size come in on the buy side after a big move down and give up a few ticks for that additional confirmation before taking along. So a major reversal or a crowded area will naturally require more confirmation. Now the other thing, the other thing we talked about in the Introduction to Order Flow webinar was the use of a longer time frame order flow tool to set bias. So footprint, cumulative delta bars are all longer term order flow tools that you can use to confirm, to get a bias. So don't just feel that you need to stick to just the DOM and the time and sales as you implement order flow, but just be careful not to add in too many ingredients. Now the other thing that's going to help is volume, and I think a lot of people disregard volume when it comes to talking about order flow. But about 1 in 10 days on the ES we get a one-way day, and often this is on the back of a news event or announcement, and these days are usually accompanied with pretty high volume. And there's often not much in terms of retracement on days like this. And the order flow itself is different too. So you still get these kind of micro ranges building on the way up in a trend, but on days like this you often just need to grit your teeth, get in and watch the order flow after your entry to make sure you aren't getting in at the top. So often you just don't get the same sort of pullback and give you a decent entry point. So always be aware of the type of day you're having and any excesses in the volume. Now it's also the same when the market slows down and you get into a tight range. You won't get pullbacks because of the tighter range. So then fading the extremes becomes a safer option. So the major minor reversals need to be taken in context. Sometimes the market goes so fast that there are no minor reversals to jump on. And sometimes it's so slow and tight there's not even any room for a minor reversal. Okay. Right, can you guys see, let me just get my, okay, I've got the cursor on. I'm a bit of a pain with the cursor on this webinar tool. Now, one of the benefits of using order flow is to filter out bad trades. So you don't get into trades where you just get stopped out anyway. Now, a fairly easy way of doing this is wait for the offer or the ceiling, so here are the offers here, to start breaking down before you go long. And for the level below to start breaking down before you go short. So if you wanted to go long and the offer here, the inside offer here was 1500, there's no need to enter, okay? Then the offer number comes down to 1,000, 800, 700, 600, 500. Then you hit into it. Then you can hit a buy market order, okay? Now obviously you still want the floor, or you still want the bids below you to be firm, but that's not absolutely essential if you've got people buying, okay? So as the offers here are reducing, you actually do want to see some buying activity here as well. Now with this technique, it works better in a thick market. So for US Treasuries, it's fine most of the time, and it's also something that's known as getting the edge, which is basically trading into a level just before it breaks and being in a break-even trade within seconds. Now what often happens is you'll be stalking a long trade. So here you are, you're waiting for the bid, you're waiting for the offer to break, but the offer doesn't break and then the market ticks down, okay? So then you wait for the next lower offer to break, but the market ticks down again. And before you know it, you're down to where your stop loss would have been and you didn't enter your long trade yet, okay? So if you're confirming with order flow, you shouldn't be getting stopped out very often. You should still be having losing trades, but there's no reason to get out just because a specific price is traded just one time. Now let's say you're long and price is moving against you and you've not yet exited because of order flow, but you're not prepared to stay in the trade past a predefined price. So let's say the predefined price was 55 down here. So you see, we tick down to this price, and we can see right now there's 1,709 contracts there. So let's say we tick down to that price, and one sell market order hits that bid, and there are now 1,708 contracts left. At this point, a traditional stop loss order will have triggered, but there's really no reason to exit. You have 1,708 contracts that need to trade at this level before price will tick down anymore. So you do the opposite of what you do on entry. You keep your finger over the button to exit, and if we go down to 800, 700, 600, 400 contracts, boom, then you exit. Now sometimes you're going to lose an additional tick doing this because somebody's just going to whack in one huge sell market order, but most of the time you can take an orderly exit, and some of the time the market will turn around, move up, and you save yourself a trade, because we've all had a market come down, hit our stop, and then immediately we've been stopped out. It turns back up our way just after we got stopped out, and we would, if we'd have just had one extra tick room in the trade, we would have been fine. Okay. Let me just try and, I might need technical help here, Mike. I can't get to the next slide.
Hit escape.
Okay, oh, there you go. Right, icebergs. Up to now, we haven't talked much about iceberg orders, but they have been in vogue of late in the retail trading world, and there's a lot of mystique surrounding them. But they really are quite simple. An iceberg order is simply a limit order that gets refreshed over time. So if you wanted to buy 10,000 contracts, it would be pretty silly to just put in a bid for 10,000 contracts, because everybody and his dog would buy in front of you. They'd basically front run you. So you put in a bid for 1,000 and you keep adding more contracts as people sell to you. And all that means is somebody wants to buy without letting, they want to buy size without letting other traders know in advance. But obviously, people paying attention to the order flow are going to notice it well before the 10,000 contracts have traded. Okay? But they'll be noticing it after somebody's already filled quite a lot of their order. Now, it can be that that bidder wants to absorb contracts, hold the market, and push it back up. But it can also just be one half of the statistical arbitrage trades, where the other half is a basket of stocks. And in that case, the trader's got absolutely no directional bias, okay? He doesn't care what happens in that particular market afterwards. He just cares about the relation between the S&P and the stocks. Okay? So for me, I've got a couple of simple rules for icebergs. First of all, the volume has to be significant. So if the average bid is 1,000 a level, I want to see 3,000 or 4,000 contracts go through. In an intraday uptrend, an iceberg on the offer side will not usually cause a reversal down. Okay? Not unless it is a price where you're already expecting a reversal to occur. So fading all icebergs is not a winning strategy. There absolutely needs to be context. Icebergs that appear out of nowhere in the path of the move are just probably stat arb, some sort of spreading activity. Either that or it's an idiot with a $50 million account. Okay? Because you're going to see this all the time. Market moves up 4 ticks, somebody absorbs 3,000. Market moves up to 4 ticks, somebody absorbs 3,000. You think, who is this guy? Because the market's going against him all the time. But it's not, he's just doing a spread trade. Now, in a move up, an iceberg on the bid side below you, behind the move, will very often stop a pullback in its tracks. So icebergs should also be ignored in the middle of a tight, choppy range. Okay? There's going to be a lot of them, and they aren't particularly significant. It's just kind of a knock-on effect of trading ranges trading a lot in the middle. Now, of course, at the extremes of the range, they are good confirmation or part of good confirmation of the range holding, but in the middle, it's really not something that's going to help. Now, stop runs are interesting because stop runs give us an opportunity to anticipate changes in the order flow. Okay, the moves are rapid. You might want to capitalize on them, or you might not, but you certainly don't want to be on the wrong side of one. Okay? Now, order flow traders, as they progress, will be thinking more and more in terms of where people are positioned, and so it makes a lot of sense to consider where they'll be out of position. Now, there does tend to be a they are out to get me mentality when it comes to stops, but I kind of prefer to think of stops as something like a natural occurrence. Okay? Now, don't think somebody is sniffing out your stop loss order, because most of us aren't big enough to even warrant sniffing out. So if your 3-lot stop lot order is 4 ticks around the ES, there could quite easily be 3,000 contracts between the current price and your stops, or rather 3,000 bids or offers between your current price and your stop. So nobody's going to buy 3,000 contracts just to stop you out and get you $150. Now, stops, if you think about it, they are areas where buyers are willing to pay higher prices and sellers are willing to sell at lower prices. And that's the reason the market goes and has a look there. Okay? It's people who are going to be, people getting into bad deals, people who are giving you a great deal basically at their expense. So don't take stops personally, but do try to benefit from them, or at least avoid having a stop run against your position. Now, we did discuss stops in the second webinar on BMT, but I'd just like to show a couple more examples before we close. Now, in this example, let's think about the buy stops, you know, in the sense that it's an area where buyers are willing to buy above market. Okay, so here we've got a top that gets hit 4 times. Okay, it's a quadruple top. At each hit to the top, more traders are going to come in short because more people are going to see it. Okay, the second time it hits that top, they're kind of the braver traders, and the third and the fourth time, they're the guys who really need it to be made obvious to them. But from left to right, you have more and more stops gathering above. In effect, you're building up more buy orders above that high and more justification for a push through the stops. And that's why you don't keep fading the ranges if it keeps hitting the extremes. So you need to identify ranges earlier and not be hitting at the 10th visit of an extreme, for example. So the longer we trade the range, the more stops gather outside the range and the more likely we'll take a peek into those generous buying and selling prices outside the range. Okay, so fading, you know, 7th, 8th time to the extreme of a range is tricky, but because at that point you've got so many more positions built within the range and you've got so many more stops outside the range. Okay, now stops aren't always building horizontally. In this case, we've got the red triangle building diagonally up below the market. And we often get these cascades setting up. You should look for this into the open of the pit session on the S&P. Okay, so the end of the overnight session often ends like this, and we have a market that's basically gradually rising higher highs and higher lows. Okay, now you're obviously going to have stops either side of any market. Okay, you always have. But if you look below, I've drawn that kind of funnel shape of where I think the sell stops are and how many, and it's growing as we go along. And again, sellers, this is sellers willing to sell at low prices. So as the market drops through 0.8, that causes to push down through the stops below 0.6 and 4. And that's what we call a stop cascade. It stops getting hit that are pushing the market lower enough to trigger other stops because there isn't much of a gap between the swing lows made on the way up. Okay? Now, whether you trade into these stops, it's sort of up to you. But being aware that a cascade is below you, especially one that builds right before the pit session opens or the day session opens, it's very important to know if that's below you, because if you're leaning on 0.8, if 0.8 here is your stop position on a long, you probably do not want to wait for it to drop through 0.8 before getting out, because you've got that additional price risk posed by that cascade of stops below you. Okay, so you have to look beyond. We hear this thing of put your stop below the last swing, and then other people say, well, that's the worst place for your stop, and there's arguments to and from. But look beyond just the last swing. Okay, and that brings us almost to the close. So if you have questions, it's probably a good time to start typing them. Now, order flow is going to benefit your trading overall, but it is going to keep you out of some good trades too. Okay, but it's the overall positive impact you're looking for. If you do use order flow, every day you turn it on, you shouldn't just start trading. You need to spend 5, 10, 15 minutes watching the order flow before you even think about making any trades. You need to see how much it's trading at each level, how volatile it is, and just getting a feel, and you call that your tuning in period. Now, in US markets open overnight, when the day session opens, the order flow will change significantly from the way it was tuning overnight. Okay? Now, there are some opportunities close to the open, but they are sort of advanced. So again, I'd say that as the market opens, give yourself that 5, 10, 15 minutes to tune in to the day session. So you have your tune in again. Okay? If you don't do that, if you just turn it on and start taking trades, you'll do badly. I can guarantee that. Now, at first, watching order flow is going to seem like hard work, and after a while you'll kind of wonder how you ever watch a price chart where very little is actually going on. So to me, watching a chart is a bit like watching paint dry. And the downside of the additional activity of watching order flow, okay, it is a bit more exciting, it is a bit more interesting, but it does give you the tendency to jump at shadows because there is all that activity all the time, and this is happening now, that's happening now. Okay, so again, that's why you need to log your off-plan trades, because you need to know if you're if you're jumping at order flow shadows effectively, and you need to discount them from your overall results, and you also need to understand the negative impact from them and kind of get out of that behavior. Okay, because it is one of the bigger risks of using order flow. Now, the best opportunities are usually reasonably obvious in terms of both the order flow and the trade location. But if you're not very selective, you're going to find yourself a lot of the time in a pretty crappy short trade when the long opportunity of the day pops up. Okay, and this really comes back to the kind of patience or impatience, because if you're impatient, you're going to take an average, maybe the market's moving up, and you take an average short and it moves down 4 ticks and then turns around and moves up another 20 or 30 ticks. Okay, you miss the easy, obvious pullback long because you're so keen to get in on the short trade. Now, you also have to acknowledge that when the range is too small to trade, that on retail commissions, there's really nothing on the table for you. Okay, so some of the short-term setups that you can take just aren't worth taking if it's only going to pay a tick or two and you're paying like $4 or $5 commissions. Okay, because if you think about it, when you factor in your risk and you factor in your commissions and you factor in your target, it's just not really worth it. You also need to become pretty merciless on cutting trades. So if you have the tools that tell you price and order flow is against you, that's great, and it's great to be able to see that, but you do actually have to close the trade as well, okay? And that goes double if you become a much shorter-term trader. If you can't take the loss when you need to, you're going to keep having single losing trades that wipe out days or weeks of profits, and that goes double for the guys that go for the shorter-term trades. Because knowing when it's against you is one thing, but hitting the exit button at that point is an absolutely different skill entirely. And with that, Mike, I think we're good.
Yeah, thanks, Pete. So there's a lot of questions on the board. Do you want to take them, or do you want me to read them to you?
Yeah, sure. I'm good. I'm good. If people want to hang around, yeah, I can do that.
Okay. Would you like me to read them, or did you want to pick them?
Yeah,
ones?
if you don't mind.
Okay.
If you don't mind, yeah.
All right. So Mervin's saying his question is, what other trading method do you think is a good icing on the cake, or something that would jive quite well with order flow?
I think the two that I prefer, basically, I prefer measured pullback. So I like to watch a market turn around. So I trade the ES. I know the ES can put in a 10, 12-point run. I like to watch the ES turn around, watch the cumulative delta turn around on that move, and then wait for a pullback. And I also like, in conjunction with that, taking trades off steps in the intraday volume profile. And those are still what I'd consider a longer-term day trades. So basically, just trading, trying to trade on the side of the volume, basically.
Okay. Pepe 2000 wants to know what your long-term win percent is.
I don't even keep stats right now, to be honest. And that's a bad question because I've just told you about logging, but I no longer keep stats. It's probably somewhere 70%, something like that.
Yeah, but I would just like to say that win percentage really doesn't mean much, in my opinion, without also knowing the expectancy. It seems.
Yeah, I mean, one of the things. Yeah, go on, sorry, Mike.
Well, it seems everyone focuses on win percentage, but if you don't know the expectancy, then it's useless by itself. I mean, I know that technically there are some advantages to having a higher win rate, but you have to know not just the win rate, but the expectancy.
Yeah, I mean, one of the things that I do is if a trade, my first target on the ES is 4 ticks, and I get that a lot of the time, but I scale out, right? So sometimes I get that 4 ticks, but I don't get any of my other scales, and I exit the break even quite often when it comes back. So I might have won on that trade, but to be honest, it wasn't really, in terms of getting that, let's say it's a 5-lot position, and you scale one contract at 4 ticks, and then you break even on the other 4 ticks, and the other 4 contracts. It's like, it's not, you might be a winning trade, but it's much smaller than a 4 or 5 tick stop out.
Right. So
it's really a kind of, I agree with Mike. I honestly quite often get the first target, but it's the rest of the trade that's kind of a little bit trickier. So again, I agree. That's another reason the win percentage is quite tricky.
So
I think if you're all in, all out, it's a lot. It's probably a better indicator.
Okay, so speaking of journaling and also talking about what you just mentioned, so there's a product out there called Trader View that I use, and there's a discount available for elite members, and they're not a sponsor, and I don't get any kind of money whatsoever for saying that. But anyway, it's a good product, and it has the ability to group by trade. So I also scale in, scale out, and it would show you a win rate based on per trade instead of per contract, just as an option, just so you know. Okay, so George is asking, what's a good way to decide if a market is too thin to trade? Is volume per minute a good measure?
Too thin to trade, it's really, I don't know, because I'll be honest. I'm going to be honest now. This is going to sound ridiculous, but I've been, somebody taught me recently to trade crude in the Asian session, and that is pretty thin. And that was scalping for 2 ticks. And I think the 2 days I did it, I took 32 trades and I had 2 losers, right? But I had a lot of scratches, right? And maybe you can count a scratch as a loser. But I don't think there is a market that's too thin to trade. I mean, the only market I think that's really too thin to trade is probably the SPI, which is really too thin. But, you know, I don't think a market is too thin to trade. It's just whether it's too thin to trade for you. Because crude, certainly, I mean, natural gas is pretty thin, but like crude, even in the Asian session, you know, just, you know, somebody just, you know, telling me, you know, approach it this way, it is tradable. But it's not something I really want to do, to be honest. So it's whether it's too thin for you is the answer. And it's not. I know it's not an answer, but that's the reality of it.
George wants to know what the best way is to anticipate chop.
Basically, what usually happens when the market gets choppy, you can tell sometimes off the open that it's getting choppy by the way it opens and the limited range. But usually when it gets into chop, the market will move, and then you'll see on the volume profile a price that will have excessive volume at 1 or 2 prices, and then it'll just start crossing over and keep crossing up and down over that price. And that's basically how those ranges form. So it starts off with volume at a price and then crossing it over, you know, up and down, over and above it.
John's asking, he says you mentioned that you can't log your trades before they happen, and it's tough to do while they're happening. So how do you log your trades personally?
I write them down. What I do, I don't do stats, but I do log. Okay. Basically, I write them down in a book. I've got a book basically. I just a little green book, and I just write down my trades. I write down my notes before the open, and I just, as soon as I enter a trade, I write down what I did and why, and then I put down the results. And basically, what I'll do is I'll just review those notes at the end of the day. I don't do stats anymore, but I want to review the notes just in case I'm getting into any bad habits, basically.
Okay. And John, I would just again mention TraderView. Again, I am not getting paid to say it, but I just happen to like the product. But if you use pretty much any popular platform or broker, it has a direct import option. So that's what I use personally. At the end of every session, Interactive Brokers emails me my statement, and I just import everything, just a raw file, one button import into TraderView, and it's got all my executions and everything right there. And then if you like to make notes and stuff, then you can go back and add notes on every trade. It automatically creates charts for you that shows your entries and exits, so you might check it out. Rusty is asking, on your chart where you track zigzags or price swings, you note the volume of the trade on each swing. Why are you doing that as opposed to the cumulative delta on each swing?
That's a good question. Basically, it works. I mean, basically, looking at the participation in the move. I mean, what you tend to see is you tend to see a relatively large amount of contracts per tick move in a stronger move, which is kind of counterintuitive. But basically, it's just participation in the move. That's all I want to use. I do have a cumulative delta chart as well, but the only thing I really use cumulative delta chart for is if there's a pullback, I want to be able to not see it in the cumulative delta. And if there's a major reversal, I want to see that really significant in the delta. But really, the delta, I'm not really worried that much about the delta in the the swing back. I want to see low volume, and I want to be aware that as the market rolls over, if we start to get significant volume in and it's moving down, it just seems to work. It just seems to work for me as good as delta, and that's why I say I think people underestimate volume as an order flow tool. I think it is another order flow tool personally.
Mervyn says, have you ever considered recording your session and reviewing it later to help you improve your trading and tracking performance, specifically if someone is an active trader? And if so, what can you suggest as a good method to review the session?
I've done that before, and I mean recently I did some crude trading on in the US day session. For various reasons. It's not the kind of market I like to trade, but absolutely recorded that and reviewed it. But I don't really have a formal methodology. This is step 1, step 2. I mean, I just use Camtasia, record it, and then basically what I go over when I take the trades, what I'm actually looking for when I take the trades, the winners and the losers, I can actually pause it and look around at lots of different things. Okay, well, what were the bids doing? And then I got into the trade, and what were the bids and offers doing? And what were the orders that were coming in? Because sometimes when you're looking at a new market, you're looking at certain things. You can't focus on everything. It's impossible, right? There's so many different, you got footprints, you got delta, you got the bids, the offers, you got the trades. You can't focus on everything. So when you're entering, you tend to focus on one or two things, or I do. So when I go and review a video afterwards, I'm trying to look at all the other stuff that's going on to see if there's something else that perhaps I should be looking at. Or, I don't really try and take too much, if there's a losing trade, I try not to obsess over the fact I lost. Some things will just lose and there'll be no indication beforehand. But I'm just looking, is there something else that I might have seen, as I go through this trade? So I like to just go through them very slowly and try and, really look around the big picture of what was happening everywhere. And then maybe I can say to myself, right, maybe these other things you should be focusing on a little bit more. So that's what I do. It's not really, I wouldn't call it a formal approach there.
Right. Many years ago, for a few months at least, was trying to study, I guess you could call it, the psychological impact that my trades was having on me. So what I did is I also used Camtasia Studio by TechSmith, and I used a little cheap webcam, right? And it can do picture-in-picture. So what I would do is record, like, screen one that had my chart and my dome, and then it would also be recording my webcam, which I would just kind of point at my body, in my chair. And then you could encode these videos to where it would like overlay kind of like a picture-in-picture of the webcam and your chart. And this is a time-consuming process, don't get me wrong, but I did it enough to where I learned a lot about my behaviorisms during my trading. For example, if you're not very comfortable in a trade, then you tend to have your back not against the back of your chair, but more leaning forward. You get anxious. It's just apparent if you watch yourself. You can kind of see and learn a lot, and that'll tell you a lot about the trade, in my opinion. I think it's very important to be comfortable with your trades. Let's see what else we've got. Ro is asking, he says Ninja has, okay, just a comment that Ninja has a journaling feature. Jeff says he uses OneNote and Evernote, and he recommends those. Hawk, I hope I said that correct, wants to know if there's a future webinar planned about context and any good sources about context.
Context, if you look at the first few webinars we did on BMT, we talked about the swings and the swing charts a little bit, but also, we could, Mike, we didn't do a webinar on volume profile yet, did we? We could perhaps do one on volume profiling later on for very short-term context, but it's certainly possible.
Abby's asking for the URL for TraderView. I don't want to turn this into a commercial, but anybody on BMT, just click the Elite Members tab, and that way you get, like, I think it's 20%. Don't hold me to it. I think it's 20% discount every month on TraderView. And they have a free option too. Pepe 2000 says he uses Bandicam for recording, and he recommends it. There's a thread on BMT for popular software used to record your screen. Let's see. Roland wants to know if you use footprint charts, and if yes, which ones, which product?
Not right now. I do like footprint charts. I think they're good. But for me, for longer term order flow, I use a cumulative delta. And I don't think there's anything wrong with footprint charts at all. It's just that it would just be too many things on my screen to make a decision. So for me, the longer term order flow, I use the cumulative delta, which is the Gomi products. And then for the shorter stuff, I obviously use my own tools for the shorter term order flow. But I think the Gomi ladder, or it's called the Gomi ladder, isn't it? The kind of footprint version. That's a good tool. It's as good as any, basically. Yeah,
there's been many variations over the years. I think one of the more popular ones these days is called Metro Highlight or something like that. If you do a keyword search for Metro Volume or Metro highlight. I think you'll find it. Someone's added a whole bunch of bells and whistles to the Gomi ones.
Yeah.
Okay, so I don't see any other questions right now. So if anybody's watching the video later and they want to get in touch with you, Peter, I see that jigsawtrading.com or your email address, peterdavies@jigsawtrading.com.
Sure.
Okay, well, thank you very much, Pete. I appreciate it. Thanks for staying up late, 1:15, and are you in Bangkok? Is that where you are?
Yeah, I'm in Bangkok. Yeah, so it's 1:15. Thank you, Mike, for the opportunity again. It's okay. I kind of get used to it now. I'm partly nocturnal trading.
All right, man. Well, have a good night, and I'll see everybody on the forum. Thanks, guys.
All right, thanks, guys. Cheers. Bye.